Hey traders, welcome back to another video. In this video, we're going to talk about this important topic, that is liquidity in trading markets. And understanding this topic would highly affect your financial trading success in trading markets, because if the markets that you trade in are not very much liquid, then you are going to run into some difficulties. So if we go ahead and define liquidity, then liquidity refers to the efficiency or the ease with which an asset or security can be converted into ready cash without affecting its price in the market. So what does a highly liquid market means? Let's take an example, a good old example of buying and selling apples. Now, if there are plenty of sellers in the market who are selling apples, then you will get apples from market easily at favorable price without much difference, because all these people who are selling these apples know that if they increase the price, no one is gonna buy from them. So that's why, because of the high availability of apples, its prices will be stable and the apples will be readily available to anyone who wants to buy. Okay, this is the case with a highly liquid market. It does not matter when you want to buy a certain currency or asset. Whenever you want to buy it, there will always be a seller who is selling it. But if we talk about less liquid markets, let's say the dragonfly fruit. Now, in this case, the scenario is there are not very much sellers. So due to only few sellers, you will not get the dragon fruit easily, and not much favorable price and much price difference between the sellers. So what this means is, since this dragon fruit is scarce and not a lot of people are selling it, so the person who wants to buy the dragon fruit will have to pay much higher prices than like how much it should be if there had been enough supply of the dragon fruit. And another thing is, the prices of these dragon fruits will vary from seller to seller, because now they'll be selling it at their desired prices. So the person who wants to buy this is at loss. Okay, so this is the case with the less liquid markets, and that's why in the beginning of this video I was saying understanding the liquidity will enable you to get higher success in trading. Because if you are trading in less liquid market, less liquid stock, then your orders will not be fulfilled right away. And now let's go to here and draw some comparison between the trading of high and low liquid markets. So if we take example of Euro USD, USD JPY, Euro JPY, these are the major currency pairs, and a lot of people are trading these currency pairs all the time. So whenever someone wants to buy a Euro USD, there is always a seller, and same is the case with USD JPY and Euro JPY. So the spreads between the bid and ask of these pairs are very low, and this allows a good opportunity for traders to go ahead and trade in these markets without getting their trades delayed, or not being able to buy the currency pairs at the desired prices. Now, every broker offers these currency pairs, and there are a lot of buyers and sellers. Also, the favorable prices for buying and selling are always available in these currency pairs. And because of this, the spreads are very low and the prices are quite stable. Now, if we again talk about the less liquid markets, there will be very low volume of stock and exotic currency pairs. Because of this, there will be a huge difference between the spreads, okay, between the bid and ask. And also, not every broker will be offering these currencies or these securities that are less liquid. And that's why the prices at which you buy or sell these assets or these securities are not very much favorable. Now let's go ahead and understand this through example on the chart. So if we go to trading view, we are on the ACN stock, and this is a New York Stock Exchange. So in this case, if we look at the 5-minute chart, now at 5-minute chart, there should not, in a very good liquid market, there should be no gaps. But if we look at this, in this case, you can see there are huge gaps between the previous and the next candles. And because of this, we can see that there is a very high spread in this case here, because there is not enough liquidity. So because of this, there are wide spreads, high volatile prices, and slower transactions. So let's say if someone wants to buy the ACN stock, 500 ACN stocks, but if nobody is selling it, then that person who wants to buy 500 stocks of ACN would get their order fulfilled in steps, and they will be getting different prices for each chunk of orders they get fulfilled. For example, if they if they want to buy 500k stocks, then their first 100k would be executed at different price than the second 100k or third 100k, like depending upon the availability of the ACN stock, their orders will be fulfilled. And these are not very favorable conditions for trading in any financial market for profits, for day traders or the retail traders. And here you can see that there are a lot of huge gaps between the prices even at 5-minute time frame. Now if we go to the liquid or very highly liquid pair, that would be Euro USD. In this pair we can see that at 5-minute time frame, the gaps or the market gaps between the prices are not very high. So because of this, the spreads are quite tight, the prices are quite stable, and orders will be fulfilled right away as soon as you place them uh, in your trading. So here you can see the difference between bid and ask is very minute, very low, even few pips. But in the case of ACN, as we saw, the bid and ask was very high. And this is an example of a highly liquid pair where your orders will get executed right away. So I hope you understand this video. Whenever you're trading, try to trade in the high liquid markets, because your opportunities for your orders to get fulfilled at desired prices will increase heavily. Please, if you have any questions, please comment down below. I would love to answer them. Also, don't forget to like, share, and subscribe. See you in the next video. Thank you.